In the summer of 2003, shoppers across America were stocking up on groceries at Stop and Shop, Giant Food, and B.I. Lowe supermarkets, completely unaware that behind the familiar facades, one of the most sophisticated international accounting frauds in corporate history was about to unravel. These seemingly American grocery chains were actually owned by Royal Ahold, a Dutch retail giant that had grown from a small Amsterdam grocery store in 1887 into Europe's largest food retailer through an aggressive acquisition strategy spanning 3 continents. But on February 24, 2003, everything changed when Ahold announced it would restate its earnings by a staggering €500 million, admitting to what would become known as one of the largest accounting frauds ever perpetrated by a European company. The revelation sent shockwaves through global financial markets, wiped out billions in shareholder value, and exposed how a respected century-old company had systematically manipulated its books to maintain the illusion of unstoppable growth. This wasn't just creative accounting or aggressive bookkeeping practices. This was deliberate, coordinated fraud that stretched from the boardrooms of Amsterdam to the back offices of American subsidiaries, involving fictional promotional allowances, fabricated joint ventures, and a web of deception that fooled auditors, regulators, and investors for years. The roots of Ahold's downfall trace back to the 1990s when the company embarked on an ambitious international expansion strategy under CEO Cees van der Hoeven, transforming itself from a primarily Dutch retailer into a global food empire. Van der Hoeven, who joined Ahold in 1993, pursued what he called a multi-local, multi-format strategy, acquiring supermarket chains across the United States, South America, Europe, and Asia, with the goal of becoming one of the world's 3 largest food retailers alongside Walmart and Carrefour. The company's growth was meteoric. By 2002, Ahold operated over 9,000 stores in 27 countries, with annual revenues exceeding €66 billion and a workforce of nearly 375,000 employees. The crown jewel of this expansion was Ahold's American operations, which included major chains like Stop and Shop in New England, Giant Food in Washington, D.C., BILO in the Southeast, and Tops Markets in upstate New York, collectively generating about 60% of the company's total revenue. Wall Street loved Ahold's story of international expansion and consistent earnings growth, pushing the company's stock price to record highs and making it one of the most valuable retailers in Europe. But beneath this impressive growth narrative, executives were under enormous pressure to meet increasingly ambitious financial targets, setting the stage for the accounting manipulations that would eventually bring down the company. The fraud at Ahold was centered primarily around promotional allowances, the rebates and marketing support payments that suppliers provide to retailers in exchange for prominent product placement, advertising, and volume commitments. In the legitimate retail world, these promotional allowances are carefully documented agreements between retailers and suppliers, with clear terms about what marketing activities will be performed and when payments will be made. However, at several Ahold subsidiaries, particularly U.S. Food Service, the company's massive food distribution arm serving restaurants and institutions, executives began systematically inflating these promotional allowances to boost reported profits. The scheme worked like this. When actual promotional allowances from suppliers weren't sufficient to meet earnings targets, executives would simply record fictional allowances, booking revenue from agreements that either didn't exist, exceeded the actual terms of real agreements, or were fabricated entirely from thin air. At U.S. Food Service alone, investigators later discovered that the company had inflated promotional allowances by at least $300 million between 2000 and 2002, with some quarters seeing fictional allowances representing more than half of the subsidiary's reported operating income. The fraud was sophisticated and systematic, involving fake documentation, forged supplier confirmations, and elaborate schemes to hide the manipulations from auditors during quarterly reviews. Even more damaging was the discovery that several legitimate suppliers were allegedly pressured or incentivized to provide false confirmations to auditors, with some vendors reportedly receiving favorable contract terms in exchange for their cooperation in the cover-up. While the promotional allowance fraud was the largest component of Ahold's accounting scandal, The company also engaged in several other deceptive practices that further inflated its financial performance and misled investors about its true business results. One particularly egregious scheme involved the manipulation of joint venture accounting, where Ahold exercised significant control over supposedly independent partnerships but avoided consolidating their financial results to hide losses and debt. In Argentina and Brazil, for example, Ahold structured deals with local partners that gave the Dutch company effective control over major supermarket chains, while technically maintaining minority ownership positions that allowed them to use equity accounting instead of full consolidation. This meant that losses from these struggling South American operations were reported as minor equity investments rather than being fully reflected in Ahold's consolidated financial statements, creating a false impression of the company's international profitability. Investigators also uncovered evidence of earnings management through the timing of asset sales, restructuring charges, and other one-time items that were strategically shifted between quarters to smooth out earnings and meet Wall Street expectations. The company's rapid acquisition strategy provided additional opportunities for manipulation, as Ahold frequently adjusted purchase price allocations and goodwill calculations to optimize reported earnings in the quarters following major deals. Perhaps most troubling was the discovery that these practices weren't limited to a few rogue subsidiaries, but appeared to be coordinated at the highest levels of the organization, with the company's Amsterdam headquarters setting aggressive financial targets that could only be met through accounting gimmicks rather than operational improvements. The unraveling of Ahold's massive fraud began in late 2002 when the company's external auditors at Deloitte & Touche started asking increasingly pointed questions about promotional allowances at U.S. food service during their year-end audit procedures. What initially appeared to be minor discrepancies in supplier confirmations quickly escalated as auditors discovered that numerous promotional allowance agreements couldn't be properly documented or verified with the claimed suppliers. The situation became untenable in early February 2003 when James Miller, the chief financial officer of U.S. Food Service, was forced to admit to Ahold's senior management that his division had been systematically overstating promotional allowances to meet earnings targets set by the parent company in Amsterdam. This confession triggered an immediate internal investigation that revealed the scope of the fraud extended far beyond a single subsidiary, involving multiple business units across different countries and affecting several years of reported financial results. On February 24, 2003, Ahold shocked the financial world by announcing that it would delay the publication of its 2002 annual results and restate earnings by approximately €500 million due to irregularities in accounting practices at several subsidiaries. The announcement was accompanied by the immediate suspension of CEO Cees van der Hoeven and CFO Michiel Meurs, along with several other senior executives who were allegedly aware of or complicit in the fraudulent practices. The market reaction was swift and brutal. Ahold's stock price plummeted by more than 60% in the days following the announcement, wiping out over €4 billion in market capitalization and making it one of the worst corporate scandals in European history. The fallout from Ahold's accounting fraud extended far beyond the company's executive suite, creating a crisis of confidence that threatened the survival of one of Europe's most prominent multinational corporations. Credit rating agencies immediately downgraded Ahold's debt to junk status, citing concerns about the company's financial stability and ability to refinance billions of euros in outstanding loans that were now at risk of being called due to covenant violations. Several major banks that had provided financing for Ahold's aggressive expansion strategy demanded immediate repayment or additional collateral, forcing the company to negotiate emergency credit facilities to avoid bankruptcy. The Dutch Stock Exchange briefly suspended trading in Ahold shares due to the extreme volatility, while regulators in multiple countries launched investigations into the company's accounting practices and corporate governance failures. Perhaps most damaging was the complete loss of credibility with suppliers, customers, and business partners who had built relationships with Ahold based on the assumption that they were dealing with a financially stable, ethically managed organization. Major suppliers began demanding cash payments or letters of credit instead of extending normal trade credit terms, while several potential acquisition targets that Ahold had been courting immediately ended negotiations. The company's international expansion plans ground to a halt as management was forced to focus entirely on financial survival rather than growth, effectively ending a decade-long strategy that had transformed Ahold into a global retail powerhouse. The scandal also triggered a broader crisis of confidence in European corporate governance, leading to new regulations and oversight mechanisms designed to prevent similar frauds in the future. As investigators and prosecutors in multiple countries began piecing together the full scope of Ahold's accounting fraud, they uncovered a pattern of criminal behavior that extended far beyond simple financial misstatement and involved deliberate obstruction of justice and witness tampering. The U.S. Securities and Exchange Commission launched a formal investigation into Ahold's American operations, focusing particularly on U.S. food service and its promotional allowance fraud, while Dutch prosecutors opened parallel criminal proceedings against the company's senior executives in Amsterdam. The investigation revealed that at least 15 current and former Ahold executives had direct knowledge of the fraudulent accounting practices, with evidence suggesting that the manipulation of financial results was not only tolerated but actively encouraged by senior management as a way to meet ambitious growth targets. Perhaps most shocking was the discovery that several executives had attempted to destroy evidence and intimidate potential witnesses once it became clear that the fraud was about to be exposed, including the deletion of computer files and attempts to pressure suppliers into maintaining false confirmations to auditors. In May 2004, the SEC reached a settlement with Ahold, requiring the company to pay $8 million in civil penalties, while agreeing to comprehensive corporate governance reforms and ongoing monitoring by an independent compliance officer. The Dutch authorities were less lenient, filing criminal charges against former CEO Cees van der Hoeven, former CFO Michiel Meurs, and several other executives for fraud, forgery, and falsification of documents. The criminal proceedings dragged on for years, but eventually resulted in suspended prison sentences and substantial fines for the key perpetrators, though many observers felt the punishments were insufficient given the scale of the fraud and its impact on shareholders and employees. The long-term consequences of Ahold's accounting scandal fundamentally transformed the company and served as a watershed moment for corporate governance practices throughout Europe and the global retail industry. Under new CEO Anders Moberg, a former IKEA executive brought in to restore credibility and rebuild the business, Ahold embarked on a comprehensive restructuring program that included the sale of non-core assets, the exit from several international markets, and a renewed focus on its strongest operations in the Netherlands and the United States. The company divested its struggling South American operations, closed underperforming stores across multiple markets, and implemented new financial controls designed to prevent the types of accounting manipulations that had led to the scandal. More significantly, Ahold completely overhauled its corporate culture and governance practices, establishing new ethics programs, whistleblower protections, and internal audit functions that were designed to identify potential problems before they could escalate into major scandals. The company also changed its relationship with suppliers, implementing new systems for tracking and verifying promotional allowances that eliminated many of the opportunities for manipulation that had enabled the original fraud. These reforms, while necessary and ultimately successful, came at enormous cost. Ahold's headcount fell by more than 50,000 employees between 2003 and 2005, while the company's international footprint shrank dramatically as management focused on profitability over growth. The financial impact was equally severe, with Ahold reporting net losses totaling more than €1 billion in 2003 and 2004, as the company absorbed the costs of the restatements, legal settlements, restructuring charges, and asset write-downs associated with cleaning up the scandal. Today, nearly 2 decades after the scandal broke, Ahold Delhaize, as the company is now known following its 2016 merger with Belgian retailer Delhaize Group, operates as a more focused but arguably stronger organization that has largely recovered from the reputational and financial damage of the accounting fraud. The merged company operates approximately 7,000 stores across Europe and the United States, generating annual revenues of over 75 billion euros while maintaining the strict financial controls and corporate governance practices that were implemented in response to the 2003 scandal. The Ahold fraud remains one of the most studied cases in business schools and compliance programs worldwide, serving as a cautionary tale about the dangers of aggressive growth strategies, inadequate internal controls, and corporate cultures that prioritize financial targets over ethical behavior. The scandal also contributed to significant regulatory changes, including enhanced auditing requirements, stronger penalties for accounting fraud, and new corporate governance standards that have been adopted across Europe and other international markets. Perhaps most importantly, the Ahold case demonstrated how quickly a respected, century-old company could be brought to the brink of collapse through accounting manipulation, while also showing that organizations can recover from even the most serious scandals through genuine reform, cultural change, and a sustained commitment to transparency and ethical business practices. The ultimate irony of the Ahold scandal is that the company's legitimate business operations were actually quite strong throughout the period of the fraud, suggesting that the accounting manipulations were not only unethical and illegal, but also entirely unnecessary for the company's long-term success.